Okay, hi everyone. This is Finance Meets Real Estate. As you guys, some of you know, we do weekly webinars every Tuesday. I'm the presenter today, which makes it a little bit easier with the initial setup. So let me share my screen. So I'm going to talk about how to pick real estate markets, and we'll take it from there. And this video is going to be on YouTube as well. Sorry, just one moment. I think I have something. Okay, so do you guys see my screen now?
Yep.
Just confirm. Okay, sounds good. Okay, so to those of you who listened to my lecture 2 weeks ago, so I spoke about data-driven real estate investing. And in case you want to check that out, it's like some introduction to today's lecture or something that relates to today's lecture. These are the topics that we discussed. So I went over automated underwriting, property condition scoring, commercial multifamily modeling, automated valuation models, market valuation, and blockchain. And when I say went over, a brief introduction to all of those. And so, that is data-driven investing. So that was like a topic that I did 2 weeks ago. Today, I'm going to talk about how to pick real estate markets, and I call it a fundamentals approach, but what it actually is it using fundamentals, but in reality, it actually means not looking at those fundamentals anymore, rather just like price time series and stuff derived from fundamentals. So it's actually a little bit of an anti-fundamentals approach that's fundamentals based. So, so that's one moment. Sorry, just wondering, yeah. Yeah, so a little bit about myself. So I'm a financial engineer by training. So I used to manage like a large derivatives portfolio together with several colleagues of mine in my finance career. And I'm a multifamily investor in the recent several years. I'm founder of a company called Realty Quant, which brings data-driven and quantitative techniques to the real estate industry. And yeah, so today we're going to talk, it's not a very long topic. We're just going to talk about two main things: predicting appreciation and predicting downside risk. I think market selection is not a complicated thing. I think it boils down to those two things. So let's take a look. So a little bit of introduction. So I'm going to present like a relatively more data-driven approach. So a little bit technical, but not too much, to market selection. And then approach is focused on price time series and what I call valuation. And I'm going to touch on that in a bit. So topics like I mentioned: predicting appreciation, predicting downside risk. So data sources are like governmental agencies' data. These are, Federal Housing Finance Agency, Bureau of Economic Analysis, United States Census Bureau. And just one moment. I just had to stop my share for a second. Sorry about that. Yeah, so so the first topic. So like most of us here, like I know some of you guys and some of you are new as well. And most of us here are investors or investment managers, like multifamily syndicators, etc. So what is the predominant approach to picking markets, at least that I have seen? Maybe I'm biased, but what I have seen, like generally in the real estate space, is okay. We look at certain fundamentals. We look at population growth, income growth, housing supply, and perhaps on the commercial side more of things like rent growth, like cap rate dynamic, job growth, etc. And in many cases, at least what I have seen, like by some investors, we may kind of be biased to pre-selecting a bunch of like hot real estate markets based on online lists, reports, investor feedback, if you will, which is valuable. Like investor intuition is valuable, and then kind of search their fundamentals and maybe back reason their strength, right? So there is a little bit of that. So like, for example, let's say we might look at this Zillow hottest markets 2020 report, and which in itself is data driven and in itself has has done a certain analysis to arrive at those cities, of course. But then my discussion here being, we look at the market fundamentals and kind of like, that's our reasoning for if there's good, strong population growth, strong income growth, etc. Then we reason that's going to lead to some kind of price appreciation for us in the future. So I'm going to argue kind of a little bit against this approach, if you will. So here's why. So it's like, I'm not making it up. It's just actual study to show like why, in my opinion, it's not the best approach. So if we look at, so two comparisons. So one is price time series analysis. I know like perhaps not everyone likes to look at like statistics and things like that, but just as an introduction, right? So one is price time series analysis. The second one is like forecasting the fundamentals. So if we think about like what we do by picking markets by fundamentals, inherently we are assuming that those fundamentals growth is going to continue in the future and then in some way translate to price growth, right? That's kind of the inherent assumption. And so to model that in a more rigorous way, I did the approach here at the bottom of this table. So I took the time series of what I consider to be the big fundamentals, at least in residential real estate, which are income, population, housing supply. And so I took those, I forecasted them, I took their histories for, 43 or 38 years, depending on data set. And then I forecasted them up to 2017, and then I forecasted them for 2 years ahead. And then based on those forecasted fundamentals, I then went on and forecasted with an additional regression, like the price changes based on that. That's one side. So this is, if you think about what this does, in a sense, it's a better, more automated way of doing and more accurate and more technical way of doing like the standard approach, which is we look at those fundamentals, we assume that that's going to translate into price growth. Okay, so that's the bottom approach. You see the error of that, 7%. So 7% is relatively high. So 7% means this is based on normalized root mean squared error. So we have like all the regions, and I did like for states, just as an introductory study. So I did it for states, and like we have all the, let's say, Arizona, et cetera, trying to predict their prices in 2018 and 2019 for 8 quarters, 2 years. And the model was within 7% of the real prices that happened, the actual prices that happened. So, but that's that kind of forecasting them ahead. It's if we're in 2017. And so 7% off. So that's if we go the fundamentals route. So what I argue is like to go instead, like just like simple price time series, forget about all that other stuff. One can look at it as supplementary data, but it's really not the way to model things. So looking at price time series, forecasting that brings us to 1.4% error. So that is a more accurate approach. And here in this, I used the exponential triple smoothing model, and I'm going to mention a little bit more about it in a moment. So this is just a model. You can actually use ETS, the same model, even in Excel, which is what Excel uses in its forecasting. But it's a sort of machine learning or like just statistical model. But again, like the argument being, picking markets by their fundamentals is a decent approach, but it has a higher price error than simply modeling price time series. And so that's more accurate to do. So that's why what is not going to be covered today is fundamentals such as population growth, income growth, housing supply growth. They're already built into the price. We forget about those. Okay. Then other real estate variables are quite important for other purposes. On the commercial side, you know that there can be like various cap rate studies, rent growth studies, etc. There can be looking at foreclosure rates, affordability, effects of public markets over private markets. Not going to look at that as well. And price-derived variables like volatility, correlation, risk-adjusted returns. They're okay as supplementary analysis, but they're not necessary for market selection. And so, proposed approach to market selection for forecasting appreciation, purely on the appreciation side, and I'm gonna, touch on the downside risk side after this. Purely appreciation side, forecast the time series. Forget about the inputs, forget about population growth, forget about income growth. It's better to forecast the time series. The intuition of that, one intuition of that could be any rational build-up into the price is something you do want to have, actually, on the upside. But you want to moderate it by having the you know, a measure of this irrational buildup on the downside risk in the next section that I'm going to touch on. But that said, like looking at the prices themselves reflects more, you know, contains inherently intuitively more information than picking a set of fundamentals and trying to model price of that, which we saw in the previous slide arrives at, you know, like about 5 times larger error. And so, yeah, so forecasting price time series, you know, several methods here. These seem to be the main methods right now. And kind of, they're pretty old, some of them. So exponential triple smoothing. So you guys, one can do those in Python, some of it even in Excel. ARIMA, like autoregressive integrated moving average model with a seasonal component is another one. So both of these performed fairly well. And then Facebook Profit is another like newer model, and I didn't get good results with it. Maybe need to spend more time, but that's kind of, those are like 2-3 of the main models, but we can see like ETS is pretty close for, so if we have a regular price cycle, when things are not extremely, you know, extremely different, you know, that something changes in the market regime, like I will show was actually in 2021, one can have a pretty small error in forecasting prices, you know, such as 1.4, 1.9%. But in 2021, that changed. And I spoke on that actually on like several events that, in my opinion, in the second and third quarter of 2021, the US real estate showed the first indications of entering a market bubble. Now, with that, how do you see it simply on the price time series side? Well, our error term increases. It's harder to forecast prices when things change, when they start entering a market bubble. And so exponential triple smoothing, 5.6% error for 2021, harder to predict those price growths, which are no longer based on fundamentals, no longer based on what historically has been happening as well. And so seasonal, like ARIMA 6.2% and Facebook Profit, like pretty big error. And so, yeah. This is the forecasted appreciation by US state for just 1 year ahead. So that's this here data is based through, is kind of through Q3 of 2021, and then 1 year ahead of that. But sort of a 2022 projection, call it approximately. And so these are like some of the regions that if you just take the time series based on a projection that in normal conditions, it has like 1.4% error. But as you see in less normal conditions, it has 5.6% error. You know, these are kind of the projections of where appreciation is going to be this cycle if things continue. But again, this is a very short term, it's very biased to like very nearby strong performances, it seems. And so like things like places like Idaho, Utah, Arizona that heavily appreciated in 2021, you know, are showing up with pretty strong projection for the following year as well. But you know, I mean, it's not surprising. It's pretty much markets to the west and the south that are the strong ones that have performed strongly. So it should come as no surprise. Idaho, Utah, Arizona, like I mentioned, Florida, Texas, you know, Washington, Oregon, Nevada, also Tennessee is a strong one in the eastern half. So these are kind of the strong high appreciation ones. And the lowest appreciation actually, a little surprisingly, just on this 1 year forecast, North Dakota, it has performed well this market cycle, but apparently not so very recently. And then West Virginia, Alaska, South Dakota, Iowa, Louisiana, and Mississippi. But again, this assumes this forecast means nothing if we reach peak of cycle. So if we reach peak of cycle, all those correlations are going to fall through, and then it's going to be downside risk. And I'm going to look at that in a moment. And so it assumes that the peak of cycle did not happen in 2022, or it's not going to happen. But that's like just like forecasting prices, which has some kind of like I show like some kind of validity, even if it's within 5-6% error. And so forecasting for prices for the appreciation for the largest US cities, again, for 2022, you know, or through the third quarter of 2022. So it's based on county level data, the way I model it, kind of counties mapped to the specific cities, but, you know, approximately. And so the top ones, well, Boise, Tucson, Phoenix, Salt Lake City, Las Vegas, Orlando, Miami, no surprise, you know, like some of the strongest markets in the country. And more at the bottom are actually New Orleans, Washington, Toledo, Chicago, Rochester, Cincinnati. The ones at the bottom are not necessarily the weak, not all of them are the weak markets like Toledo, you know, definitely weak market in price appreciation during this cycle, but not all of them actually, but some are there's value to some showing like this kind of short-term, short-term weakness. And so this is, this is a 1 year forecast. It's 1 year ahead. So yeah, then another thing, like kind of just to build a little bit intuition on an additional thing on the price time series is autocorrelation. So autocorrelation is the correlation of this year price growth versus last year price growth, let's say, if it's a 1 year time lag. And so autocorrelation based on like 45 years returns history for all the US states, but that's based on Federal Reserve Bank of St. Louis data. And then in FHFA data, it's a little different and that. But you can see actually in this data set at least, like places like Florida, California, you're not able to see Massachusetts here as well, have pretty high autocorrelation. So if you want to predict next year prices, it's really like 77% correlated with last price performance is 77% correlated with last year price performance in Florida, or in California even, and so forth. So this is like an interesting thing. And these are kind of like the top ones and the bottom ones in autocorrelation. Like the notable exception is Alaska, where it's negative autocorrelation. So there you actually, if prices perform well, you might expect the opposite, which is unusual. But in most places, like this is a measure of, okay, there is trend, there is momentum in real estate. And also it's a measure of what in finance, they call it the recent weak form efficiency. So it means kind of real estate, US real estate doesn't appear to be overly weak form efficient either, by that sense, based on like 70% and 60% and so forth, autocorrelation. And so that's that. And then market performance is, and I didn't have time to update this slide. It's like a 1 year old data, but kind of like the market performance since the latest fair evaluation, which occurred at different times in different states and counties, etc. But the fair evaluation is, let's say, maybe in 2010 or 2011, something like that. And what is the market performance since then? And once one knows this kind of like fair evaluation starting point, then you can measure appreciation properly, and you can see, okay, the Western states and Southern states are the booming ones, the ones in dark green over here. And so, which, kind of everybody knows in a way, right? Or most people. But then if you look at the market performance in the largest US cities, again, kind of proxied by county level data, then you see, okay, Boise is at the top, as the top performing city. And then there are like other cities in Colorado, in Texas, Florida, et cetera, places like Denver, Austin, Miami, Phoenix are the top performing ones. And just one moment. And then, yeah, at the bottom, like worst performing ones. And this is again, like the whole market cycle, because the forecast appreciation that I showed was like just for 1 year ahead, let's say, but this is kind of like historically, like where the prices have been. And one can one can reason, it's not like super statistically valid, but one can reason, okay, let's take this appreciation. And this is like how strong those markets have been this cycle. And then one can also take autocorrelation and say, okay, if those are markets that have trend, that have autocorrelation, then that's your kind of like high level intuitive predictor of prices for the future. Or you can do what they showed, the 3 methods: exponential, triple smoothing, Starima, or Facebook profit. And so that for this. And then, yeah, then predicting downside risk, the second topic. So it's not like a very long discussion today. So second topic, predicting downside risk, is, based on like in finance, this is a study by John Hussman from Hussman Investment Trust, listing like the correlation or predictive power for various measures versus actual subsequent S&P 500 total returns. And it kind of like it's used as a measuring the bubble, kind of, he calls it, So I'm not sure it shows pretty high correlations. I'm not sure how they're derived like myself, because it does seem much harder to predict things in the stock market than in real estate. But it's kind of a little bit inspired from that. But then the question is, if we're measuring downside risk, so what is our dependent variable? So in statistics, you have a dependent variable, like a predicted variable, and then you have independent variables, or like predictive variables, call it, right? And so what is our predicted variable? I think we're relatively fortunate at the time to have this, well, otherwise negative event of post the global financial crisis that we can calibrate to. And it's not perfect. This is just an assumption that any future scenario would tie to that or would be a correction scenario, because it doesn't need to be a correction scenario. It could be something else. It could be, like reduced price growth, income super growth, like different like fundamental super growth and things like that. There can be other scenarios to that, but still, like we have a scenario, we have a situation of when a large price correction happened to US real estate, and so we can calibrate to that. So we can use the downturns, the price drops, peak to bottom, post the global financial crisis as a dependent variable, and try to derive a measure for downside risk. And so at the state level, the median peak was in the fourth quarter of 2007, and then the bottom was like 4 years and 1 quarter later in the first quarter of 2012. And you can see here, and you can see here like the big dropping states of California, Nevada, Arizona, and Florida at the time. And what is our independent variable? So I'm gonna talk about this a bit more, but let's say it's gonna be based on like regional like price and income and possibly population, housing supply time series. And so depending on data set and approach, et cetera, the valuation call it in those terms, or predictor of downside risk, showed like 83 to 87% correlation versus subsequent actual price drops at the state level. So to clarify what this correlation means for the less trustful ones is, well, look at the map here. That's the dark blue states that were most overvalued prior to the global financial crisis, and then look at the map of the predicted or dependent variable, which is the same 4 states of California, Nevada, Arizona, and Florida. I mean, it's not just them that feed the correlations, the whole vector, but you can see like the overvalued states are the ones that drop the most, and then you can look in the middle, the ones that didn't drop, like Texas, or very little, like 4%. Texas, Oklahoma, Kansas, etc., were actually undervalued. They were with negative valuation. And so approaches to building this kind of downside risk predictor. So here, any mention of like housing shortages like means the population to housing supply ratios. And so let's say ratio-based approaches and regression-based approaches. So ratio-based approaches, the most common one that economists sometimes quote, if you have a price income ratio, and then and then you have a history of price income ratios. And then if a price income ratio deviates from the historical data, but you have to use like a moving average of those historical price income ratios as well. So if it deviates from a moving average where it seems it works best on a 20-year window, then that's your, the percentage deviation from that is your ratio-based predictor variable, if you will, for downside risk or market valuation, as they call it. So that showed about 87%, if we exclude the District of Columbia, about 87% correlation to subsequent price drops. So it's actually very strong. It's both simple and it's also very strong. And then ratio-based, kind of a double ratio. So if you think about like housing shortage, like people talk about housing shortage or what, there's so much housing shortage developing here and there. I don't know, it's not always the case. If you look at take population and housing supply ratios, in some areas they're worsening, the ratio, in some areas it's improving. And the two measures kind of tend to catch up to each other and so forth. But in some areas, yes, there is developing some housing shortage that does get built into the price. So it's already reflected in the price, in fact. But then, so let's say that the measure tends to be in the range of 1.75 to 2.25. So if you take population to housing supply to total number of housing units in any market, it tends to be 1.75 to 2.25. So, okay, so it's a number around 2. So you can easily normalize by a number around 2. So you can take price income ratios, which are, let's say, 6 to 20 or something like that, and you can divide them by 2 or by 1.75 up to 2.25. And you can get a normalized metric that now reflects housing shortage too. So if it reflects housing shortage, the expectation is that now that ought to model better large cities. So that ought to model places like San Francisco and et cetera, it ought to model them better. Because why? Because price income ratios, they don't stay the same over time. So they tend to enter a new regime when, for example, a large city just experiences, well, housing shortage and it becomes very not affordable. So the, let's say, price income ratio could dramatically change over time. And so an approach could be, okay, let's incorporate housing shortage and try to get, you know, some correlation, but well, here it didn't improve results. So 80, 84, 85%, and still very strong. So that's like a ratio-based approach. And then regression-based approach, the simple regression-based approach, so you take price time series, you take income time series, you do a regression on them. So one can go like trying to do like more advanced regressions or something, but the reality is the relationships are fairly linear between these variables. So linear regression does the job, it seems. So here, a 20-year regression of price and income time series, 86% correlation. And to clarify the deviation from that. So we attempt to predict where the price should be based on the income time series. And then deviation from that is our predictor of downside risk. And that predictor of downside risk correlates 86% to the actual downside. So that's kind of the approach. And then the second approach is regression-based, but was also ratio kind of. So we have the ratio of housing supply, housing shortage, the one that I mentioned, 175 to 225 range. So we have the housing shortage ratio, but then we have incomes. And then the second approach is, okay, let's regress incomes and this housing shortage, the two variables, regress them against prices and try to arrive at, and do maybe a 30-year regression on that. And try to arrive at like a predictor of where prices should be. If it deviates from that, that's your measure of downside risk. So that showed 85.6% correlation in the study. So also very strong. So also very strong. And then for some reason that I still haven't understood, actually a regression of all the variables does not perform well. So it's under 60% correlation. Doesn't perform well if we do a regression on income, population, housing supply, all of them. So that's kind of like a multiple regression approach. So yeah, so bottom line, like just to sum it up, like to share like high correlation of what they call market valuation or predictors of downside risk post the global financial crisis being the study here. And so using various approaches. And so here is kind of, I mean, the numbers there, here is like based on one of those methods. So I use an income-based, this is either ratio numbers or like regression-based income numbers. So one of the high-performing methods, they all performed really well, except the multiple regression one. And this is where market valuations are at the end of the third quarter of 2021. And that I have discussed like in other lectures as well, that the 5 states of Idaho, Nevada, Utah, Arizona, and Colorado appear to be entering a market bubble. When I say that, it's really based on, well, it's based on their valuations over 4 years back, which were in a certain range, and then they jumped strongly above that in the second and third quarter of 2021 with what seems to be excess asset inflation over wage inflation. And so that, and Texas and Florida is not seen here, it's probably around 17%. So Texas and Florida, they're not too bad. I don't think they're in a bubble, but they did showed similar indication as much in other places in the country of kind of changing market regime from where there was an extremely stable market, valuations not changing over 4 years, and then suddenly kind of jumping up in 2021. So that's where valuations are now. So I don't know, like Idaho and other places have like the bigger downside risk. So if one did the assumption of a price correction similar to the global financial crisis, now that's just an assumption. Maybe prices are not going to correct at all. Even if you have something like Idaho at 47% above where it should be based on fundamentals, like on the approaches that I discussed previously. So even if you have that, it doesn't mean it's going to correct it. You can have income super growth. What if income like heavily booms and then catches up to prices, or what if, or other fundamentals as well, like income, population, housing supply, right? And then what also another scenario is that just prices experience reduced growth and then fundamentals catch up to them kind of over time and the two get aligned. In theory, it's possible. It just has been our experience historically that most of the time, if something deviates too much, it does tend to be a correction. So hopefully not. In the event there is a correction, which is we can safely say global financial crisis is a pretty negative event. So it's pretty worst case scenario. So that's kind of like predicted drops in that scenario. So that's a county level regression for the same. So the same thing for 2,700 US counties rather than just the states, showed like 73 to 77% correlation versus subsequent actual price drops until bottom. And these are the valuations in like large cities, like cities with, I guess, over 200,000 population. Boise, Phoenix, Tampa, Fort Worth, Las Vegas, St. Pete are some well-known, relatively overvalued cities, with Boise very overvalued, and so cap rates and interest rate relationships. So if you take an approach of, this, right, like doing a ratio-based or regression-based analysis where we try to arrive at where the fundamental level, what the fundamental level should be, deviation from that, and showing that it actually had predictive power. So if we take this approach, but then we raise an interest rate change over time, we can, one can say maybe this is meaningless because now interest rates are super low. What do these valuations even mean? Maybe you should adjust for interest rates. If that was the case, one would then actually adjust for interest rates. That's not too hard. You can do that. But then the thing is, here, I will argue that actually that's not necessary. So it's because, okay, if we look at cap rates and interest rates, they have a pretty strong relationship. I know about 65% correlation, or maybe 70 in some studies, or they have a relatively strong relationship. And so if our measure of valuation was not like that more advanced, like several approaches that I showed, but if we were, let's say, like some economists, were doing things like price to rent ratios. And let's say we can say that price to rent ratios, well, they don't have the expenses that are built into a cap rate, but in a sense, they're like correlated or close to inverse cap rates. So they ought to be adjusted for interest rates, right? Because cap rates are correlated to interest rates. And so approximate inverse cap rates are correlated to interest rates. So if we had a valuation based on price to rent ratios, then that ought to be adjusted. But then if we have a valuation that is based on incomes and population, housing supply, and that, so I would argue it's not the case, because, and here's why. So if we look at market valuation in the US over 45 years, it's around 6, like in this kind of study. So, and then, but we are in the 40, so kind of fairly flat, and then we're in the 40 years. And I'm not sure actually if this absolute ratio of 6 is perfectly correct, or it might be normalized in some way. But so I need to see. But the bottom line is it's a flat trend where it doesn't change. But then interest rates were actually trending down for 40 years, as most of you know. And so doesn't seem like valuable to actually adjust for interest rates. So no interest rate adjustment there. And then, yeah, so here, like some summary, since we went like at first over like forecasting appreciation. So if you remember, like exponential triple smoothing and like 2 other methods, Facebook profit and SARIMA model. So forecasted appreciation, if we can say, it's not like the markets here the safest in this sense, because we have a forecasted appreciation on very short-term horizon. So just like only 1 year ahead. But if one wants, okay, to combine forecasted appreciation 1 year ahead with market valuation, let's say markets that are less than 5%, that's kind of fairly valued to undervalued, and this just states. I mean, it's actually California. Surprising, California is expensive. Nobody wants to buy there, but well, it's not overvalued now. It's a result of this kind of lack of investor appetite. So it tends to be. So it's in this list and then Massachusetts, Pennsylvania, Indiana, Kentucky, and Ohio would be kind of in this market cycle now the example of states that fall in this category that, well, they are under to fairly valued, but they have a relatively high forecasted appreciation for over a 1 year ahead window. And then for cities, so that would be, various cities like Greensboro, Atlanta is there, and well, San Francisco, again, due to this kind of undervaluation that it has now. And so Boston, Indianapolis, places like that. These are some places, meaning which have under fair valuation and that have had relatively high forecasted appreciation. And so but then the one can take a different approach too. Since, okay, it's hard to forecast appreciation like too far ahead into the future, one can just look at the full history of, now we have like about 10 years of history of data since the last fair valuation around 2010, but varying across region. And so it can take since the last fair valuation until now, what has been the price appreciation in different places, and the ones that are under to fairly valued. And again, that's another slide I didn't update. I didn't have time. So it's like 1 year old that this one slide on specifically. But it's basically like these are some of the states that are, you know, under to fairly valued, you know, again, California, Indiana, Kentucky, New York, Massachusetts, you know, like places like that. So they're under to fairly valued, but some of them have performed fairly decently since their last fair valuation. So that's another approach. And the same thing for cities. So for cities, again, in California, you know, also the cities of Jersey City, Atlanta, Pittsburgh have performed actually strongly, and they're still undervalued. That's a little bit lagging that, or like under to fairly valued. And so summary points. So like I mentioned at the beginning, if you remember the first study here, sorry, let me just come back for a second. So if you remember like this study, so this is one of my main arguments. So if we have like investors or investment managers select market by population growth, income growth, housing supply, inherently they're doing a less good version of the model down here that has a 7% price error. So inherently what they're doing is inferring that this growth in those fundamentals is going to continue. And then assuming that that's going to reflect in prices in some way. And sort of you're trying to get the best appreciation prediction, right? And so that has a 7% error, where you get a 5 times less error in normal markets when they don't start entering power, like in 2021, is the top scenario forecasting price series themselves. Because why? Prices reflect more than just the fundamentals we thought of, because they may reflect irrational pricing. And that's going to be seen in market valuation, then on the downside risk side. But it's useful but if you do want to model just prices while we're in the upward cycle, it's good to do it like that. So this is like the first, the first conclusion point, that real estate fundamentals such as income, population, housing supply, they're either barely reflecting the price already, or market valuation reflects those. And price appreciation is better predicted of price time series alone versus predicting the fundamentals. And then the other thing is market valuations based on deviation from fundamentals serve strong predictors to downside under a price correction scenario. If prices don't correct, then they would less serve a predictor. But if you have a price correction scenario, such as post the global financial crisis, they're the thing to look at. They serve as like strong prediction to downside. And then final point, a mixed price time series market valuation approach achieves the best analysis of market selection, in my opinion, of price appreciation and downside risk. For the reasons mentioned above, that market fundamentals are reflected in the price. You model the price best itself for appreciation without those fundamentals, but they being reflected in the price gives you a measure of downside risk. And so looking at price time series and market valuation combined approach is, in my opinion, the best for market selection. And so further info, so market valuations and appreciation data. So my company Realty Quant has market valuations data for 2,700 US counties. If you guys want to sign up for our investor list, it's also there. And I will be doing a data-driven real estate investing course as well. And then the YouTube channel for Finance Meets Real Estate is like Finance Meets Real Estate on YouTube. So that's everything. So if you guys have any questions, let me know.
Hey, hi, Stefan. How are you?
Yeah,
just
good.
a question here. So a couple of things that I'm thinking about is, as you know, because of COVID, there's a lot of like work from home, and it looks like there's going to be a lot of hybrid work. And also like the life sciences, we're talking about like Boston is a place where it's huge in life sciences and work from home. What is your opinion? Like, what do you think work from home and life sciences will bring into the real estate market?
Yeah, I mean, these are like this is like this kind of speculative things. These things they're good, but they're very hard to predict in a data way, right? So you can, we can speculate or have intuition for certain areas booming more than others, kind of changing trend. So, I mean, I guess my answer to this is if those, let's say work from home or life sciences, if it's already in some way reflected by market participants and it's already in the prices, then you're going to get it here. So then you're going to get, that's why if we try to predict price appreciation and it's a normal market cycle, we get only 1.4% error. So it's where prices are going to be 2 years ahead here, predicting 2018, 2019 versus actual only 1.4%. So if things are already in the price, now if you're having a change in regime, that's the kind of thing that investors want to notice, right? To your point. So let's see where things are going to go. And that's, maybe it's not a question for me because then that's not going to be data. So then that's just going to be, okay, like you just work out your intuition. I mean, that can be like running like some of the machine learning methods that pick up social media signals, I think, and stuff like that, trying to predict if people in specific areas want to move to suburbs or if there's like you mentioned, like certain industry developments, but kind of a little bit not exactly the scope of, I guess, of this today. And then, so a question, so Rohan is asking if I look at market volatility. I did. So I did look at market volatility. You can look at, I did a lecture in July of 2020 that was showing like various slides for market volatility, correlations, risk-adjusted returns, kind of like Sharpe ratios in finance. So like price returns adjusted by volatility. And it's not very useful. That's what I have to say. You can look at market volatility, but basically it's going to show you, if you take the state of Florida, it's going to show you Florida having high volatility. And what does this mean? Are you predicting appreciation with it? Are you predicting downside? Which variable that you care about are you actually predicting? None. And Florida is going to show very high volatility. And in fact, the Sharpe ratio, the risk-adjusted returns of Florida by this kind of limited measure may appear relatively low. And then one main reason Florida is not such a great place, but that doesn't align with intuition. We know like where big investors have gone, which is for valid reasons, et cetera, and where most of the booming appreciation in the eastern half of the US has been, which is Florida. And so again, it's not how to say, it's not, volatility seems more useful in the stock market for different reasons. I mean, also because you have option pricing, I guess, and things like that. But otherwise, in real estate, I feel it's not very useful. I think part of it is there is a different profile to downside risk, where in real estate downside, like, I mean, we see it's measured by deviation from fundamentals by like some of the other like the different measures that I showed is one thing, but also downside doesn't arise out of, let's say, very undesirable markets in itself, which is a little bit of the stock market dynamic, where, it seems to arise from that, like if you have penny stocks and things like that. But then in real estate, the downside is not. And so in those markets have extremely low volatility. They might show decent risk-adjusted returns, adjusted by volatility. And yet, are they the good markets? No, everybody knows. I mean, that place like West Virginia and Mississippi would fall in this category. So they would be very favorable in volatility terms, but they, as investors, we know they're not the attractive ones. And that, so volatility doesn't seem very useful in real estate. That's kind of my take, but I did like studies of volatility before, and yeah. So so Richard is asking where was Austin, since it should be high on the list. Do you wanna speak up, Richard, or I can look up? Yeah, I mean, Austin is high on the list. Yeah, it's high on the list of appreciating markets, of course. So it's also relatively high on the list of somewhat overvalued ones. So Austin, just one moment. So if you want to look up, well, it didn't filter for this kind of short-term 1 year forecast at the very top. I'm sure it's like right after for like forecasting appreciation. But if you look at like the more historic performance, Austin is right there at the top with Denver, Boise, Miami, and places like that. So it should be no surprise. But then if you want to see as to whether Austin is under, fairly overvalued or overvalued, well, then just one moment. Then, yeah, well, then it is in the relatively overvalued range that they're in about 23%. And then people tend to be skeptical. They say, oh, it's such a these places are extremely strong markets, you know. And how are you going to say that they're going to be overvalued if they're so strong? They have so much, they have so many people moving. Well, sure, and they have incomes and stuff, but that's going to get reflected. That's going to be in the population variable. It's going to be in the income variable. It's going to be in everything else. So if you see that, it has some meaning. And again, like this is, you know, some of the overvalued places. If you look at, let's say, Boise, so it's overvalued. And then sometimes maybe people would think that I'm bearish on Boise or something because here it shows overvalued. It's not true, because if you look at the 1 year forecast for appreciation, sorry, this one, Boise's, no, sorry, that's like the 1 year, yeah. So Boise is right at the top. Yeah.
Hey, Amy. So what about, hey, thanks for it. This is cool. I appreciate it. I kind of came in late. So, but
no
this is kind of some of the conversations we've already been having. But
yes.
What if the prices is just, it's the new normal? What if the baseline shifted? So where do you take into account for that, right? So what if, it might be overvalued, but it's going to go back down. It probably will still continue to grow, right? You know what I mean?
Well, yes, Amy, I know this is exactly the thought process of people in like really hot, strong markets. I mean, if we have, you're saying, let's say Austin. So if things have changed in Austin, right? And, you know, it's an extremely booming place. It has like so many employers there, you know, so much job growth, things like that. And that's the new normal. So how are you going to say if Austin is overvalued? I mean, first of all, to be overvalued, like we discussed, like here, actually, it's only a downside risk measure. Simultaneously with being overvalued, the same city, just like Boise, gets predicted with the highest forecast of price appreciation during the market cycle, unless we reach peak, and then the downside comes into place. But simultaneously, it's the one that I would predict that it's going to appreciate the most, because that's just what the data says, right? But then the answer to your question is, well, if indeed things have changed in Austin, let's say, or on another market, so then we're going to see it. It's going to show up in income growth. It's going to show up in population growth. It's going to show up somewhere. And if it doesn't show in those fundamentals, then it's happening the same thing as in all the other market cycles with hot markets. It's only hot markets that get overvalued. Typically, that's what happens. Generally, it is the case. There's not gonna be any drop in West Virginia. There's not gonna be any drop in Mississippi. There isn't gonna be a drop in the Northeast this market cycle likely. But it's again, like your question is valid, but that's gonna show up in those. It's gonna show up in population, it's gonna show up in income if things have indeed changed. And if it's more than that, then, I mean, I can give you the example of, let's say, of Denver, Colorado. So Denver, Colorado, that was since it's good that I have an old slide here, because it's actually going to help for this. So if we look at, sorry, just one moment. I think I thought I have it. Oh no, damn it. Anyway, so at the beginning of COVID, Denver, Colorado was at exactly 0% valuation in this framework. Denver, Colorado, as we saw in the market performances, is in the top 5 cities. So it doesn't have to be that it deviates. It doesn't have to be. If Austin is, if its fundamentals are being up to speed, and whichever regime changes Austin experiences or another city, whichever regime changes its experiences, if they are reflected then it could perform extremely strong. And nobody's going to say that a strong performing market, it's overvalued just because it's strong performing. Because that was the case of Denver. It heavily exploded and it stayed fairly valued. And then now afterwards, it's a little bit overvalued. I believe 12%. It's not major. It's just 12%. But again, this is the question here to ask is where, if let's say a booming market has changed the regime and has become amazing, where is that going to go? It has to go in incomes. It has to go in population. It has to go somewhere. And if it doesn't go in those fundamentals enough and prices are above that, then that's your predictor of downside risk. And the reason for that is, well, like this table here. If you did a ratio-based approach, and these are multiple different approaches versus fundamentals, ratio-based versus income, ratio-based versus income, population, housing supply, regression-based versus income, regression-based versus income and housing shortage, regression-based versus income, population, housing supply. And so, it's all going to be reflected. That's it. Like if people think these fundamentals don't capture it, I don't think so. Now, there is a possibility for small geographies. Now, there is a little bit of aspect of small geographies indeed, which is where I wanted to add housing shortage. And maybe indeed there is more to predicting something like a city, and that's a valid point. And that's why once you see it in the data, then once you're predicting small geographies like counties or city, well, correlation drops by about 10%. And it's not so great. And if you even just look at the numbers, they're not well aligned. It's not like the states, right? So it's like 77% correlation, it's worse. So, I mean, these kind of small topical things, they're hard to predict. But yeah. And so, okay, so a question. So Kati is asking, so a broader factor than work from home, how do population variations affect these models for prediction? I think population, households, not headcount, would have the greatest influence. Comment.
Yeah, I think you covered that
okay,
earlier, sure. And I
came
in late, so I didn't see it, and I was just curious about it. But I think you have it in some of your earlier slides.
Mm-hmm. Right. So depends for what? For upside or for downside, let's say, for which direction? It's a little bit different. Like for appreciation predicting, well, that's what we were predicting, right? This kind of thing.
Yeah, I guess it would probably factor in more in decline, mm-hmm. Right?
So
because it would remove a baseline of demand. If there's it's an oversupply, it turns into an oversupply issue, right?
True. Yeah, it does have a role on decline, and it does have a role on the upside. I mean, of course, since that's how people they're not entirely wrong by picking by population and these things, which sort of works. But my argument for that on the upside is the following. I gave like this comparison here. So if you're looking at fundamentals of prices and not running a simple regression for a forecasting kind of model on price time series, and most people don't want to do it, but it's a simple price time series forecast that, you commit a higher error in your price prediction. Here, the error of looking at fundamentals, forecasting that and forecasting prices of fundamentals is 7%. This is inherently what people do by picking by population, income, housing supply, things like that. Except it's actually worse what they do. Here it's done by an actual model, but if it's done even by a model, it has 5 times bigger error than if you actually model the prices themselves. It has a 7% error here at the state level, 1.4%, really tight, very good price prediction when just looking at the price time series. So this is my answer to that. So population, yeah, it beats the price time series, no question about it, but don't model that. Model the price time series themselves. Then on the downside risk is here. So on the downside risk, the way population enters primarily is I look at it as housing shortage. And the way housing shortage enters is that housing shortage results in changes in affordability in regions. where they change regime over time with housing shortage. And so that's where is the way it enters is like one way would be like the approach here, the ratio based. So doing like a ratio of affordability to housing shortage. And that's population and housing supply. And that was predictive of downturns. And then another would be in a regression-based sense, doing a similar study regression-based or income, population, housing supply all-time series. And there is like a strong correlation to downside risk. I mean, if somebody wants to, let's say, argue that like things have changed now, like why have they changed now? Like if somebody wants to argue that, let's say, fundamentals, we will not predict anything, you know, things are going to be random, like in the stock market. Well, this is not Tesla. These are not technology stocks. This is real estate. This is basic stuff. This is like utility stocks in finance. If we cannot predict utility stocks in finance, what are we even doing in that market? And we're in real estate. We can predict a lot of stuff. And because it's fundamental, it's easy. We're fortunate, it's very easy. Had we been doing with the stock market, I don't know what market valuation is in the stock market. I don't know, because it's technology companies. You have to build some kind of very complicated models, perhaps, to model that. You know, what should Tesla be worth? What should even Google be worth? I don't know. In real estate, we know. We know property valuation. We can discover discounted properties. And like what is the argument here? We know market valuation. So it should not be like this kind of mindset that is instilled in us from like, I don't know, like news and like finance and things like that, that it's crazy hard to predict, because it's not. I mean, some things are hard to predict, but real estate is not. It's relatively easy. And so, yeah, so population factors into like downside risk like that. And on the upside, like better to not look at it per se, to look at the price time series, which are reflected. But that is just at least my perspective. That's kind of like the argument here. So essentially what this lecture is, it's a very simple, like short lecture that argues focusing on price time series and valuation and not looking at fundamentals themselves. Why? Because the first point, looking at fundamentals results in 5 times bigger error if you're trying to predict upside. 2, if you're trying to predict downside, then you use those fundamentals, but that's like coevaluation. So you use the fundamentals on the downside to predict, to have a valuation, to have a predictor of downside risk. And then that's, you know, kind of like that's that. So this kind of like the thesis here versus like the more standard thing that probably people expect of, you know, like to pull population growth. And I have the statistics on like population and income and so forth. And I had shown them in a different lecture, but the goal here is not to focus on that, but just to use them the right way. And the right way to use them is modeling time series for appreciation and doing market valuation for downside risk. And this is kind of like, I guess, my thesis here at least. And then, so Neil's question, if you had to buy a 300,000 home for rental, assuming a 5-year hold period, where would you park your money? Good question. Yes, so assuming then where you would park your money, the way I would do it, at least, I would run, I mean, it's gonna depend on the property, right? So it's gonna be if that property is undervalued, what is the cap rate on that property? You know, if that property, if you can experience some equity gain, forced appreciation on that property, things like that, right? So it's gonna be up to that primarily. And as most investors know, they mostly focus on properties, and that's like what's most important. It's more important than markets indeed. But just one moment. But what I would do is, I would do a forecast of, sorry, just kind of jumping around, but trying to find, I would do a forecast of prices where instead of forecasting here 1 year ahead, like this forecast for 2022, it would be 5 years ahead, and it's going to be less accurate. So the error, instead of being, you know, 1.4% or 5% up to or something, it's going to be perhaps higher. But I would forecast like 5-year appreciation, or look at autocorrelation, or look at strong performing markets that have high autocorrelation, that have lots of trend, that just people keep buying all the time if things are going favorably. And kind of use that as my appreciation predictor. And then buying, I mean, it depends. I don't know how risk averse you are. You can buy to the south even now. It's not a crazy bubble. Like if we look at valuations, if we look at market valuations in Texas and Florida doesn't show up. It's around 17% perhaps. So it's not a crazy bubble. It's just 17, 18%. And things have just started to even enter a bubble by kind of, statistical sense. So it's like fairly new. It can go for 4 years or who knows how long. So you can buy to the south if you want to do that, as long as you keep tracking valuations then quarterly and keep knowing what's your downside risk, and at some point sell. But that's the thing that usually, like, that's what makes it very hard to time the market, like in the stock market. For me, at least, is like my issue with the stock market is always I don't know valuation. So it's like constantly this question of when are you going to enter, when are you going to exit, and you always don't time it right, and you end up losing money. And so here, if you do have valuation, if you track quarterly in the southern states, you can do okay, even if prices at some point take a downturn. But other than that, it would be, it would be kind of in the Midwest and places like Indiana, Kentucky, and Ohio, where you would be more protected from actually prices not dropping. As far as if you want to be like protected from downside risk. I mean, if you go in a place like, like New York State, which is undervalued 3%, and upstate New York is more dramatically undervalued, prices are not going to drop. That's what we have seen statistically. That's what was during the global financial crisis. They're going to drop like 4%. They're going to drop with incomes. Valuations are going to stay the same. So you would be protected. If you buy in Western states, you would have very high forecasts of short-term appreciation. So you have very high forecasts like in this table, where is it? Just one second. Like in this table, like in Boise. So where is going to be the biggest forecast of short-term appreciation? It's going to be in Boise because it's performing the best. But what's going to carry the biggest downside risk? It's going to be Boise again, because it's actually most overvalued. And so, I mean, that happens to be, it doesn't need to be the two coincide like that. It just happens to be, since it's a very shifted, very outlier situation there, it seems. And so then, but you can invest there even now if you want. It just, I don't know what the timing is going to be. If the market cycle continues 4 years ahead and you invest in Boise now, it's going to be booming. So it's going to be having very high appreciation, but you're going to carry high downside risk all this time. And you can be aware of it and can be responsible for it, because it's there. If you didn't know it's there, you didn't measure it, but it's there. And so that's kind of like the approach to that. And if you go in Indiana, Kentucky, Ohio, you would probably have less forecasted appreciation for the same 5 years, let's say, or 2 years or 1 year, but you would also have less downside risk afterwards. So it's just kind of a decision. But if you have these kind of measures and you track them over time and you keep recomputing them quarterly, or you can use our data in derivative one as well. So then you would know that. Yeah. And so how do you account for local economy affecting housing markets? For example, annual state GDP or purchasing power parity growth rate or other economic variables? Well, not in a statistical way, don't account for those, but they get reflected. My answer to that is local economy, other metrics get reflected in what can be called the fundamental metrics to real estate price growth, which are, population, income, and housing supply, arguably. And so they're going to be reflected there. If it's a strong economy, people's incomes get higher, people are moving to that area, etc. The question is, what are the fundamentals that we should be kind of assessing to arrive at downside risk? Since, like I mentioned, for upside, we don't even care. We don't even need to know what they are. We can just model the price time series and we will have a smaller error. But again, like the argument here is what are the fundamentals? And so if those other local variables are not direct fundamentals to real estate price growth, then you don't use them. If they indirectly feed those fundamental metrics, then they would be reflected there. And so that's kind of my answer to that. But of course, I mean, for small geographies, there's various stuff that it's just going to be a little hard to predict. I mean, but even just population in itself is super hard to predict. If you try to predict population growth in like counties or something, it will be all over the place. You cannot guess where the population is going to go. People can move all kinds of ways. And so like, I always get like this kind of argument for, I mean, if you're looking at these kind of broad things, so why don't you get more topical and get even that? Why don't you get hyper topical and let's look at my exact neighborhood next to my house and how that's going to perform? Oh, sure, we can get more topical. And you know what's going to happen? You can do all the labor with all the data, get even more topical. And what's going to happen is your predictive power is going to be dropping and dropping and dropping. And so there is a trade-off. So then you're working for that more topical thing with a lesser accuracy. And you can do it. So the same way, like if you have a state level prediction, you get, for downside risk here, we get predictive power in the 80s%. If you go to the counties, you get predictive power in the 70s%. And I haven't gone to the zip codes here, but if you go to the zip codes, then maybe it's going to be in the 60s%. The answer to that is, yeah, you can get super hyper topical or try to, but either you do like massive labor, massive machine learning, and some kind of like I said, like the kind of thing of picking social media signals, or you would invariably lose predictive power. So when people say like, real estate investors, they say real estate is very local and like very, very topical, and we don't care what happens at the county level. We don't care what happens at the state level. We don't care about any of that. Even the zip code, we don't care. We care about our exact neighborhood. Well, sure, try to predict that. It's going to be harder. So yeah, so if you have other questions, let me know. Yeah, Richard, I see you're unmuted. Do you want to speak up? No. Yeah, Katya, I think you worry about like your market taking a downturn or something like that. Where are you located?
Sorry, I was muted. Well, I'm located outside Cleveland. Okay. I have one property in Massachusetts, and I have a couple here in the Cleveland suburbs. And I agree with your remarks about neighborhoods and individual communities being a better, like that's where it all happens, right? A lot of it does, but so I'm not worried. I'm just, and I'm not actively buying at the moment, which means I'm trying to imagine how to apply your observations. But I will start to buy in the future, and I'm just trying to figure out how to make those decisions. So,
right. Well, let me see if wasn't sure. Sorry, I keep jumping on these slides. I wasn't sure if I had Cleveland here. Perhaps yes. Well, that's for let's see the downside risk. No, I kind of think here included just the overvalued ones. But Cleveland is, let's see if we look at the states. So, the state of Ohio, Cleveland was quite undervalued. Cleveland is a bit weaker price performer in Ohio, right? Not as weak as Toledo, for example, but weaker definitely than Columbus, right? And also weaker than Cincinnati, relatively speaking, in price terms. And so Cleveland was undervalued, definitely, but Ohio a little bit picked up now recently, again, with inflation. And so, as you can see here, the state went to 4%, kind of fairly valued. It was in the negative before. So before 2021 kind of boom that happened, it was in the negative. And so I would not be concerned there. I'm looking at that market for this kind of strategy to be protected from downside. That not Cleveland maybe so in particular, but Ohio overall. These are the kind of these are the kind of The thing is that now if Ohio is at 4%, then you cannot say it's actually protected from a downturn. If you have something in Illinois that is heavily depressed, you see here it's like 16% undervalued. That's never gonna drop. That's gonna, I mean, that can drop like 2% or something, or whichever like income drop happens there. By income, it is gonna drop because things drop by income, it seems in this scenario, but it's not, you know, but it's protected. And that is like, you know, that's the kind of thing that I try to, you know, a little bit show to people that if you look at, I mean, if you look at the drops that happened post the global financial crisis here, for example, and again, this is just a scenario, I agree to that. It's just it's an extreme correction scenario. We can have a different scenario also in the future. But still, all the undervalued states in the middle, they have, sorry, undervalued states here in the middle on this map. So if you look at like Texas was 5% undervalued, let's say. It dropped only 4% and so forth. So that's, and I have like, I had a table for this, like with all the undervalued states, and there are about 10 of them, and they dropped on average only 4%. This is a valuable observation right there. If you want to find value on like discount on downside risk, what is more valuable than knowing that, well, that's states. And then if the count is, you know, to like I showed before, 73, 77%, lesser correlation. But again, if you're in an undervalued county, in an undervalued state, what happens if you have a systemic crash and big price correction to real estate, your prices may drop kind of by income only. And basically your valuation stay the same. And so undervalued real estate doesn't drop. That's what I have seen. And then what we have seen in like in the poor states like West Virginia and places like that, I feel like some real estate investors, they tend to think, I saw somebody on LinkedIn saying something like, buy Houston assets, let's say. And Houston is a great city. And like I said here, it's going to be very high on the forecasted appreciation ranking. It's going to rank high for sure because it performs great and it has done great. But again, you know, there was like this kind of argument, buy Houston assets. And I'm like, seriously? This is like some kind of like a religious cult or something, you know? There is no such thing as like a strong asset that is protected on the downsides. That's not how it works. The strong assets are the ones that have a bigger downside risk, in fact, most of the time, once we're at the end of the cycle. So there's no such thing. The weak assets, like Class C, D buildings in the Northeast are the ones that are not gonna drop because nobody wants them now. They don't become overvalued and they're not gonna drop. And that's why, like I mentioned before, like that, you know, I have observed like previously, in the current cycle, you know, places like West Virginia, you know, you see, we can look at Alabama even, etc., are undervalued. And so, Alabama is now fairly valued, okay, I believe. But you know, they don't, they don't experience big drops. So it's quite interesting. So even though they're weak, so there isn't like this kind of perspective of strength inherently associated with some regions when it comes to downside. Downside is driven by irrational, it seems to be driven. It is, and again, like to clarify, like when before I did like this kind of studies here, because here you see like 5 different approaches to try to gauge market risk, downside risk. So the reason why you see them, I kind of like tested like different ones, right? But then I actually looked at before at various other metrics, like somebody asked about volatility. I was looking at volatility. It's one of them, and risk-adjusted returns. And was looking at foreclosure rates. Foreclosure rates is another thing that doesn't predict downside risk. So there is like somebody was saying at the beginning of COVID, there was a study based on Atom Data Solutions, which is a great vendor that has like great foreclosure data indeed. And so there was a study on top of them that was showing how, for example, counties in New Jersey, and there was like Sussex County, New Jersey, and some other counties where they have relatively high foreclosure rates. And New Jersey is kind of a top foreclosure state, like consistently, at least at the current time. And so it was showing how they are more prone to downturn because they have this kind of foreclosure rates. And that couldn't be further from the truth, because in that list, in fact, was New Jersey, and also Florida is a relatively high foreclosure state, kind of like top 5. But then they're very, very different. Florida is, you know, indeed in the slightly somewhat overvalued range. And then New Jersey is undervalued. Now, other than something in Hudson County, New Jersey, which is where I have invested, for example, you know, if that's to drop, that can drop, yes, because it's fairly valued. Fairly valued things can drop. but the dramatically undervalued state of New Jersey with its undervalued counties that nobody wants is not going to drop this market cycle. And as much as like investors in the Northeast, they may say how things are, the market is hot and it's hard to get properties and things are expensive. But when you look at it actually versus fundamentals, it's going to show that it's not the case. It's in fact even undervalued. And so this is, like this kind of perspective on downside. And I think generally like the Midwest, Midwest, the weak regions of the Midwest and Northeast right now are going to carry the least risk. But again, if you get more topical, there are places where, let's say, at least like I mentioned at the beginning of COVID, Denver, in spite of being the most booming place in Colorado and overall nationwide very booming as well, was actually the most fairly valued county in the state compared to other ones. So that's quite interesting. So it doesn't have to be that things go above their fundamentals. It doesn't have to be. I mean, even until now, this is so many years of booming growth in Texas and Florida, and things have grown a little bit above fundamentals. But where one I think should be more concerned is like in the 5 states to the west, like Idaho and Nevada, Utah, Arizona, and Colorado. But that became only in last year. That wasn't the case until then. So until the first quarter of 2021, they were fairly valued. No, they were slightly overvalued. Never mind. No, Idaho was the only one that was actually really overvalued, even then at 25%, and the other ones were slightly overvalued. But again, it wasn't major, and there was not some major spike in that to indicate bubble formation, something like that. And like in these studies, like I have mentioned in other, like before we wrap up, since it's way kind of already over time, but so like I mentioned in other talks, like these studies, there's a study for the Atlantic University, kind of like just looks at kind of the price series deviation from some kind of long-term trend. It's even simpler in a way. And then there is Bloomberg Economics. Then there's Local Market Monitor. These are different ones. And so all of those studies until the beginning of 2021 even, things were fairly valued. So things started getting not fairly valued, like in this map here afterwards. But again, like to clarify, because people still do get confused about this, they tend to think that, okay, I'm like kind of blacklisting as if those states to the west. No, because if you look at the forecast appreciation, again, in just one moment, sorry. The forecast. If you look at the forecasted appreciation, it's going to be in some of the same cities and some of the same states. It's going to be to the west. That's going to be the places that are forecasted to experience the most appreciation. It's both things at the same time. And that's it. Okay, so thank you guys for joining. Any last questions for today? Okay, thank you so much. Have a good night. Bye-bye.
Thank you.